Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
All right. Hey, welcome to today's podcast. Before we get going, I just want to, we just came off of the solar eclipse. We're a day after the solar eclipse. So what were y'all's thoughts? Where were you? What'd you do to reign in the day?
Oh, that's good. Well, Andrew, you want to go first? Because yours is pretty exciting. You're kind of having your own solar eclipse, weren't you?
Yeah, I guess you could say that.
You're kind of seeing some of your own shadows, or kind of like that.
I was being mooned. Yeah. I was in the middle of in a dark room, looking at a sonogram of because we're expecting, and so we went to see our 20-week appointment or whatever it is, and got to experience seeing my unborn baby and see the little alien as the moon went across the the sun. So I missed that, but I got to see what actually counts. So
you should have run out in the middle of it. You should have just run out in the middle. I'll be right back, honey. Gone out and taken a peek.
You know, it's funny. My wife actually said to the tech, she said, you could hurry up a little bit. Maybe we can catch the end of it. And I looked at her and I said, I don't think this is something that we want to hurry up.
Well, I'll ask you later if there's been a big gender reveal out of this, sonogram. So as Mason, as you know, I live up in the Seattle area. And so I was watching it on the news and watching, like in Mexico and then Kerrville, Texas. And I was like, oh, this is really great. And I'm like, I kept looking outside, going, and at the peak of it, you see at the peak of it, that's me in Seattle. We got nothing. We got clouds, and maybe I think we only got like 22% coverage, but we never even saw if it covered or not because it's always kind of dark and cloudy. So we kind of live in this quarter eclipse.
Yeah, my favorite thing about it was when it was about 5 minutes after. It was, I mean, we went outside to see it. We kind of saw the little sliver, which is really cool. But my favorite thing was when we were driving after the appointment, you could see everybody went outside, right? Everybody went outside, but no one's looking. No one is. There were maybe a handful, but everybody's looking at their phone. It's like you came outside and you're looking at your phone.
Mason, where were you?
I was at home, worked from home, and stood out in the street and watched it. And it was a great experience. Really cool. Thought it was a little anticlimactic though. They overhyped it. I think they said, yeah, it's going to be completely dark, be safe driving, all this kind of stuff. It was never completely dark. I mean, it got dark, but I think they set the bar too high.
I was told an Uber driver, a friend of mine, he had to turn on his headlights during it, and so yeah.
Well, yeah.
Well, that's good. Well, we probably ought to get into the podcast, but
let's get on to the podcast. Let's get started.
This is going to air a few weeks after the. People listening to this and you go, "What eclipse were you talking about?" Oh yeah, the last one, a month ago.
They can remember back.
Okay, let's jump in.
All right. So today we're going to be talking about types of upside, and we're just going to give definitions of what types of upside we have, examples of when it's gone well, when it's gone poorly. So let's go ahead and start with seller financing. What is it, and what are some examples of when it's gone well and when it's gone poorly?
Great question. And like a lot of sellers, so a lot of people listening to this podcast may be contemplating selling their business at some point. Just realize that I think some of the last statistics I saw on this, 80%, or it's a really high percentage of small businesses that sell, small to mid-size, have some element of seller financing involved with the deal. It doesn't always have to be that way, and we'll walk through maybe some of the ways it works and some of the ways it doesn't. But basically, it's where you are a piece of the structure. If you're selling your business, let's say you sell your business for $5 million, and they're coming to the table with, $2 million of equity. They've borrowed $1 million in debt, and or $2 million in debt, and there's another $1 million sliver out there. They may ask if you want to seller finance that at a certain term at a certain rate for a certain amount of time. So it can go really well. It can be a really good thing. There's a lot of limitations with it, which we can kind of get into. When you start dealing, it depends on if it's, being financed, if it's an SBA deal, they have limitations on what can happen to that, how quickly that piece can get paid off. So it really takes either an advisor who really knows how to structure that, or, a bank that's being really upfront about how they can structure it and what position you're in. And so, in a nutshell, that's what it is. And we can get into other things if you want, but in a nutshell, that's what it is.
The upside to doing seller financing is one, it's really for the buyer, but also if you're going to wait more or a longer time to get what you're actually selling, then the purchase price is probably going to increase. Maybe not, but it more than likely will. And then there might be a component of an interest rate. It gets a little fuzzy there. It may or may not have an interest rate, but that there might be some upside with that. And so it's mostly used as a form of funding, less more for upside, but it can have some upside.
All right. So what are some examples of when seller financing has gone well and when it's gone poorly?
Well, when it went really poorly was one of our own deals that we did. And we kind of knew going in it was going to be it was really about the only way the deal could get done. And we covered what we needed to get out of the deal on the front end for the most part. So we knew that this would be a little extra. And we knew that we just thought that would be a better way to do it because we wanted the deal to get done. We really didn't want to be managing this business anymore. So we did that. And over time, they kept piling on senior debt in front of us. And then they went belly up. And, that was a deal went bad. We got payments for a couple of years and that was about it. And so, going in, I think there has to be these eyes wide open thing going in. But most of the time, that's very unusual because most of the time, we knew the risk going into that. It was a pretty high risk deal. So we kind of knew, like I said, most of the time it's not that risky and it's all in how it's structured. So you want to make sure you don't have too many layers of financing above you. Most owners don't like it because there's going to be senior debt in most cases, and they're going to be secondary. There's not a bank out there who's going to lend senior money at the good rates that's going to have a loan in front of them. So, and that's the way most owners would like it, but that just didn't happen that way. But you can protect yourselves in some other ways. You can put some clauses in there. So if there's a sale, it's paid off. There's, if you're dealing with SBA, you have to kind of watch it because SBA only allows subordinated loans to be paid off at a certain pace, or they can't be paid off in some cases before their loan is. And so, but you can also use this really creatively. And this is where I think we've really learned through the years to make it creative. On one of our other deals, it did work out well. We tagged on some seller debt. We kind of needed up front. We got on the seller debt side, but we tied it to an earnout. Now we're going to get to earnouts here in a minute, but we actually tied it to an earnout where if we didn't make the earnout, instead of it, it just came off the amount of the note, off the principal of the note. It worked out well. It was 1 year we didn't make the earnout, but the other years we did. And so, it all panned out. The other thing you can do that makes a deal worthwhile with this is that in most deals, there's a holdback. And so those who are listening, say you sell a deal for $10 million, it would not be unusual for there to be $1 million holdback. They're going to take $1 million and it's going to be put in escrow, or they're going to owe that in a certain amount of time, typically 1 or 2 years. Sometimes you can kind of make that in different tranches along the way that's paid back. But what you can do, instead of having if you've got seller financing, what you could do instead of having a holdback or a large holdback, you can tie the indemnity claims. So holdback is in case you have an indemnity claim against anything you've indemnified the seller for, and then, or excuse me, the buyer for. And so let's say you have an indemnity claim that would come off of your seller note rather than having this holdback. So there are some creative ways to use a seller note that can be, effective and useful for both parties. And that means you would get more of your funds up front by not having the holdback.
Yeah. And honestly, you guys have learned, Dave, you and Grant have learned kind of the hard way in some cases, right? For seller financing. And to be honest, in the last few years, it really, I have not seen any. I can't recall anything that has gone poorly as far as seller financing goes. And I think that, look, seller financing, it's mostly straightforward. Obviously, like Dave mentioned, you can be pretty creative in things, but it's pretty straightforward. And so I know. Most of our clients, especially kind of in that sub $5 million businesses, if there's a certain amount of seller financing, then the question is, how do you secure it? What happens if they don't pay it? All of those questions really arise. And look, at the end of the day, it's their choice if they want to actually finance the deal, right? And one of the points that you made was we wanted to get out of this deal, and we wanted to stop managing this business, and so we financed. And that's the case for a lot of people, but it is the seller's choice.
Yeah, the motives are different, and so and the other thing I think we can talk a little bit about rolled equity. But rolled equity is one of those, we've seen more rolled equity in recent deals than we have seller financing. And rolled equity is a way to take seller financing and turn it into equity. So let's just use real life example. We have, you sell a $10 million company and you own 100%. Well, you want to, let's say your trend is really good. So your sales are going up. And here you are, you've decided to sell, and you're having a banner year, but you haven't realized those gains yet. But you being the very prideful business owner that you are, you want to be paid for those gains, or you want to be paid for, hey, this has got to keep up next year. So one way you can share in that is to roll some of your equity, and this is really big in the private equity world. They love it. Most of them love it when an owner will roll their equity. And they're just basically taking an equity position in the new company. Instead of getting paid, say, $2 million, they're taking 20% of their equity, and they're becoming a 20% equity partner in this new deal. And it can work. Maybe, Andrew, explain a little bit about the platform, how that works on platform versus, a tuck-in later on. But platform is where you kind of want to be involved with that, I think, in most cases.
Yeah. So rolled equity, examples of when it's gone well, when it's gone poorly. Have you been involved in a deal yourself with rolled equity for one of y'all's businesses?
Yes, we are, and we're still in the process. We'll see what shakes out with it. I mean, it was a company that was bought by private equity, and we believed in them. Our main person who was running our company stayed with them, so we believed in him as well. Again, we believe in management, so. In that particular case, we collectively as a partnership decided that we would roll 20% into the next deal. And here's why. We wanted a second bite of the apple. We were content with what we got for the company, but we figured these guys are going to go on and they're going to use our company as a platform company. And then they're going to start buying other companies and putting them underneath it. And so we did some protections on it to where we have we were always going to be in a good position because it's a platform company. We would keep the same position as some of the original equity holders, which was important. And as they tuck in, we hope that someday they'll sell that. Their plan was a 5 to 7 year plan. We're probably 4 years into it. They'll sell it someday, we hope, and we'll get a second bite of the apple. If it sells for, with a profit, we'll get that 20%. And so it was worth it to us because, we believe in where it was going to go. And it was a way for us to make a future investment. And we have nothing to do with the management of that business. We have nothing to do with it.
I mean, it's two scenarios. Are you going to stay involved with the company or are you not? And you guys did not. But at the same time, while you trusted the company, you trusted the general manager of that company, right? And the way that he was projecting it, or directing it. I think that's key, because there are times where I mean that's a big part of why a buyer wants to use some rolled equity. Yes, to fund it, but really they can trust that the seller is kind of putting his mouth his money where his mouth is, right? And that he's keeping money in the company and investing it alongside them and showing that he believes in the company enough to succeed on its own. It on the flip side, if they're staying in there, it's also a great way for the buyer to solidify the seller's commitment to the company, if he is staying on. And so it's really situational. I know I can recall a time where a client of ours, he was rolling 30, I can't remember the exact numbers, 30%, we'll call it, over to the new company, or the new co as it's called by popularity. But he wasn't necessarily going to stay with the business. And there was some, his general manager kind of bought in a little bit. And so he rolled his equity and over. And so it was really a way for the GM to be on the same side of the table as not only the buyer, but also the seller that's rolling equity. Because if the seller and the buyer don't know each other, how can he trust the company to do well if they're not controlling it anymore?
Right, especially if they haven't had any experience in this particular business, right?
Exactly. So there's so many ways you can treat rolled equity, but you're right. Being a platform, though, that's going to be mostly when it's used, and the reason is because you can you're selling it at an X amount, and hopefully it'll grow. And unfortunately, this has happened. In fact, actually, we've recently covered this kind of offer with a client had received, where they received the actual enterprise value of the company per this offer was about $20 million, and the seller was getting about 13 up front. He's rolling 40 something percent. But the buyer proposed that the company would grow from a 4 million EBITDA company to an 11 million EBITDA in just a few years. And so they would sell then at a greater multiple. And they proposed that the seller was going to get a total of over 50 million or something like that of the combined initial and second transactions. The problem was that it didn't address how they were going to grow the company. They grew by acquisition. Then the percentage, the rolled equity percentage was going to go down if he didn't provide any capital for that next acquisition. Yeah, and so the buyer had historically a hands-off approach to the operations, and so we had to ask the questions. Well, if you're going to be running the company, why aren't you already achieving 11 million in EBITDA already?
Well, this company had been going for several decades, right? It's a great company, but it's still, you have to, it's a little bit.
Our client didn't see the 20 million. They saw the 50 million as a purchase price. And this is absolutely why you have to, it's why that kind of proposal is dangerous. And why you need to get somebody in the room that has that experience with this kind of verbiage, enough to negotiate some of those things in there, or just even flat out tell you that, hey, don't take the offer.
That's a perfect example and this is not a slam on private equity. It's just oftentimes you got to remember, a lot of private equity companies they may be on their first platform or second, but they've never been in the trenches owning their own business necessarily. They've owned them maybe from a high level, or they've got, they've hired guns going in. And I think a lot of advisors are in the same position. I think that one of the advantages we do have, I think, with ICCG is that Grant and I have owned a lot of businesses 3 years, and we've really screwed up in some certain circumstances. We've learned the hard way, and we would never do that way again. And so our clients benefit from that because we would never do that for them again. But that's a great example, Andrew, of you can make a spreadsheet, say whatever you want it to say. I can, the pie is the sky out there, but there's a reality to the reality check that comes along with that's really important. One thing I wanted to point out about the rolled equity, which is a little unusual, and one of the deals we did, it may be the one you're referring to prior to this one, Andrew, was I think this person had sold some of their equity to the general manager, which was a great idea because then he was able to roll his equity in, and the buyers wanted that. They almost demanded that because it kept him bought in, right? But the unique thing about that particular situation is they came in with little debt. And what that allowed them to do is make distributions. And so actually the rolled equity, they're making distributions at least once a year for any profit that comes through the business. And so that was a really unusual situation. All that to say, every deal is structured separately and differently.
Yeah, that's great. Earlier you mentioned an earnout. I just want to go back to that. And what is it? And what are some examples of when it's gone well?
Earnouts are based on different things, and it's really hard to say this is an earnout. But basically, it's this: you're tying a seller to where they can receive an earnout. They can receive additional funds as the business performs certain KPIs or whatever. So say, and we'd like to tie it to revenue when at all possible, because a seller may have some influence on how they introduce customers to the new people. They may be able to influence customers to keep buying from that particular person. Let's say it's a manufacturing company, and they may have those relationships that they can help continue on. Where they lose control, those with the cost. And so a lot of people want to tie it to the bottom line, which isn't a bad idea. It's just the seller has no control over that, has the least amount of control. Not that they have control over the revenue, but again, we did one up here, up in the Northwest, that was a home service business, and he'd had really consistent sales. And so they said, I'll tell you what, for the next 2 years, if you hit just the same sales figure that you hit last year, I mean, if you feel that positive that we're not going to lose any customers and we're going to keep going, because that's really the biggest concern. Are we going to lose customers when we change ownership? We'll pay you, whatever the number was, $100,000 over, each year for the next couple of years. And I think he made those earnouts in both times. So there's different ways to do earnouts. Most people don't want to, they think it gets too complicated. What we tell people is, let's keep it simple. Let's see if we can come out with something. It works really well if you have it. It shows the confidence that a seller has in their business. I get a little squeamish if a seller's like, no, I don't want anything to do with an earnout. I don't even want to talk about it. I'm thinking, well, but you just told me how great your business was and how your trending is up and you believe in what you're doing, but all of a sudden now you don't. So, there's kind of pros and cons there.
And even one of the cons, from the buy side is that, a buyer is going to say, okay, especially if the seller might have a little bit more control. Control is a big piece, right? They lose a big con for a seller is that they lose control, or they may or may not lose control of how the performance is in the company. And so even on revenue, if I'm selling my company and my landscape company and I don't have any more control, but I tie it to an earnout, can I trust him to market the company well, to do, to grow it, or else I'm not gonna get anything for it, and so that's where it's kind of tough. Now on the flip side, on the buyer, if he remains, then you really, are they going to try to just cut costs so that they can get more sales, but I'm not going to earn anything, out of it on the bottom line. And so this was kind of a specific scenario that we just had with, we received an offer, for a company, and we didn't end up taking it, but essentially the way it was structured was there was an earnout. If he hits this amount, then he gets a certain portion of this, or a certain percentage of the sales, and as long as the gross profit was greater than, or it hit a certain level, right? A certain 30% or whatever it was, 40% or whatever it was. And that ensured that they were going to not only have money in the bank to pay him that 5% or 2% or whatever it was of the sales, but it also allowed them to secure some bottom line for them. And he was involved with the sales of the company, the marketing of the company, and so that was a unique way. I just thought that was a good way to structure it.
All that to say, again, it can get as creative as you need to be. Just make sure that if you start dabbling this, you've got people alongside you who can get creative with you, and you've got good attorneys or advisors who are advising and giving good advice to protect you in it.
Yeah, absolutely. Well, that's all we have for today. Thanks for tuning in, and we're gonna dive deeper into this types of upside and deal components in a future episode. So stay tuned.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.